What is going on? It's Mike, and yeah, so just today's show and little snippet about market is one that just kind of talk about really what we're seeing with headlines. The markets are reacting to war headlines, job data, retail spending, but I'm also watching homes get 10 to 15 offers in California. So the question that we have is what's happening right now? We have what I call the macro chaos, which is geopolitics, right? The Iran situation, what's happening overseas, Strait of Hormuz. Of course, we see market volatility because of oil prices and things of that sort, right? Now, we're also seeing our current administration signaling that the war is going to ending soon, right? Or the war that will end soon. However, we're getting a lot of mixed signals. So the markets are more or less reacting headline to headline, which is interesting as someone who studies data throughout the day, throughout open markets, even looking at futures, we're seeing that, this is headline driven volatility and not fundamentals. And what I mean by that is we're looking at markets that will shift based off of one news outlet saying that, it going viral, another saying this, that going viral, and the market's reacting. We had a great rally, of course, if you looked at the stock market and your market indices yesterday. However, when you see these market indices, a lot of it was driven by actual real data coming out versus the headlines. Now you see these headlines come out because the headlines, as I mentioned previously a couple days ago, is kind of a bait for click. You're going to click, you're going to view, you're going to watch, you're going to share. As that happens, it dries up revenue for these mainstream media companies. As that happens, you tend to see more volatility, or the markets respond to that rather than actual analytical data. I mentioned yesterday, as I was talking about this, we used to look at newspapers before, of course, when I started 24 years ago. Yes, we had the internet, just things were not as quick, as tangible as we have today. So you're going to see greater responses in what I call knee-jerk situations and it calming when the true data comes out, which is, I think, what we're seeing, right? So now we're looking at the jobs in the economy, seeing 62 jobs started based off the ADP report versus 40, which was expected. Of course, it beat that number, right? 62 over 40 is a good number, but it was weak. Now, keep in mind that nearly all the growth was in education and health, and of course, the private economy, which is a huge part of our, job market in the United States, was basically flat. So if you strip out the government style jobs, hiring itself is barely growing. Now, if you look at retail sales, it was stronger than expected, but of course, that was the pre-oil spike. So really, consumers looked okay in February. However, March is a different story. And of course, we don't get that data yet, or we won't get it truly until we start seeing it take root into this month as we see April, right? You start to, like anything, you see a seed planted, it starts to grow, it continues to bear fruit, and you see what you get, whether good or bad fruit. And of course, you'll know it by its fruit, right? So when you look at the mortgage rate market today, of course, rates moved up and then applications dropped. However, when we look at the purchases are down short term. So it's still greater year over year. However, we're seeing greater numbers. We're seeing greater purchases take place year over year. So it's actually busier than last year. Last year's a pretty down year. If you look at the numbers, it was slow for a lot of folks in our industry. But now we're starting to see buyers not so skittish in some markets. We're seeing some markets that are thriving, and we're going to talk about that in a second. So keep in mind that yes, refinances are a little bit sensitive. However, they are still up year over year, and demand reacts fast to those rates. It truly hasn't disappeared. Now, what we're seeing in some markets, and this is what I really want to talk about, 20 to 25 offers on some properties. I was trying to help win an offer with a 10-day closing on a condo in San Francisco. I was talking about this with, a really sharp close of escrow, great clients, but they were beat out by seven other offers. So what we're seeing in actuality in certain markets, especially the major metros like San Francisco, which essentially, again, has its own economy because of the AI development and what's been going on with tech. You're seeing 5 to 15 offers on good homes. You're seeing application volume rising, and you're also seeing serious buyer traffic, which is normal for this time of year. So, yes. What we need to contrast is more sellers than buyers in certain markets. However, we're starting to see buyers come into those markets. You're also seeing multiple offers still happening. So the data says one thing, right? More sellers than buyers, home prices dropping. This is, basic new price is what the listings will show, or, improved price or price improvement, right? But often it's the seller who's not listening to their agent. And this is one thing I'll share with anybody who's looking to sell their property or contemplating it. Connect with a good agent. If you need a good agent, wherever you are, if you're in the 50 states, we will find you an amazing one to help market and be honest about how to list that property and what it would actually sell for. And the reason why I say this is multiple offers are still happening in most markets. You just have to market it properly, be realistic with the price and realistic what's going on in your geographic location. And again, I want to point to San Francisco. San Francisco, we're seeing a new angle, which is another tech effect. Now, I'm old enough to remember I grew up in the Bay Area, spent a lot of time growing up in the city, San Francisco, hometown, right? So we're seeing what we see this tech effect. We saw that in 2000 with .com. We saw it, of course, uh, post Great Recession and throughout the Great Recession with technology like the Meta, which was then Facebook, Instagram, Twitter. These technology companies emerging. Salesforce, of course, throughout that their Salesforce Tower, which candidly, if you work at Salesforce, forgive me for saying so. I'm not a fan of your building. I miss the old San Francisco skyline I grew up with. Driving on 80 as you look over, if you're driving through that part of the East Bay or 580, should I say, and you see that, it just doesn't look cool, guys. Sorry. Just my opinion. But that being said, you're starting to see 25% increases in activity, especially even in condo markets, which is rare. Condos are hard to finance these days. Condos, because of Senate Bill 326, there's balcony research and inspection that needs to take place. You have to make sure that there's really no pending assessments. They're more difficult to finance than they have been in years. However, even condos are thriving, especially in good markets. And this is again going back to that tech market. Now we're seeing the AI market come out. So you're seeing the AI market. You're seeing technology companies emerge. People moving back to San Francisco, especially good area, right? We had this property in an area called Hayes Valley, and it again multiple offers. You're seeing certain markets like Pacific Heights, Nob Hill. These markets are emerging where they're close enough to the downtown area, close to Montgomery, which is the main artery street for really a lot of that's going on as far as financial and technology. And of course, you have the South of Market area. Anything close to this area, candidly, is thriving in San Francisco right now, which is incredible. And so you're starting to see tech liquidity. You're seeing the AI wealth cycle emerge as we've seen in the other um, items or economies, should I say, prior, like the .com. We're seeing it with, the metadata, Instagram, Twitter, and now you're seeing cash buyers re-entering because the AI growth is now emerging through San Francisco. So AI is creating a new buyer class. And they're not rate sensitive. They're buying cash. They're doing what they can if they want to leverage to actually get into a property. So here's the truth of it all. I said this yesterday. I'm going to say it again today. This is not one market, it's two. Market A, good homes, priced right, strong areas, multiple offers. That's that simple, right? Those three things. Good homes again, priced right, and then strong market areas. That means multiple offers. Market B, and this is why, again, if you're not working with a solid agent that really knows your market or will market and be honest with their approach on how they're market, let me know. I'd love to make an introduction to an agent or area to help you. But market B is overpriced, not such a great location in some areas, needs work, tends to sit. Days on market, in case you're wondering, if your property's sitting for 2, 3, 4 weeks or more, you tend to get a price reduction. The more days on market, the longer it sits, the more, of course, the liability. If the seller has a mortgage, they're paying that liability a little bit longer. And then so we have to come into a realistic price reduction to meet the market price of that area, or a buyer may come in, offer something less than what the asking price is. And that's the opportunity for buyers. So what I'll share with that is if you're a buyer in this market and you're in those markets, look at days on market. That would be the strong move to see if perhaps the seller would come down in price, work with you on price, credits towards closing costs, or anything of that sort, right? So that's what I'd share with you for a buyer in this market. Really, the final take is demand doesn't disappear. It just got selective, right? In some markets, it actually got stronger. So what I'd share with you is don't follow the headlines. Seriously, I would recommend following true data. Follow your market. Listen to the team that you're working with. If you're working with me, of course, I check in with you every Monday, let you know what's going on, update scenarios for you, whatever it may be. Work with a team that does that. That's the most important thing to do, I think, in this market and in any other market. And for that, that's kind of my tidbit for today. Hoping you all have a blessed day. Thank you for joining me.